All right, we've been covering this development tied to Barrick, which is navigating some uncertainty with its mine in Mali, where the company now is posting a $1 billion net charge tied to that. I want to get some insight and analysis from Steve Rowles, who's a senior portfolio manager at TriVest Wealth Counsel with Wellington-Altus Private Counsel. Steve, thanks very much for being with us. What's been your reaction to this Barrick story?
Hi, John. Great to be here. It's a story that's been ongoing. $1 billion charge is more than expected. There's been a military coup there 4 years ago, and they've really taken over. And this is quite concerning. $1 billion charge is a lot more than the market anticipated. Still, not a lot of clarity there, and that's been the issue with Barrick. It's a great company. Despite the Mali situation, great earnings today. The production increased across the board. It was pretty strong earnings report, but all the focus is on the Mali situation. $1 billion is more than expected, and that's why we're seeing markets react negatively today.
You know, we've had obviously a stellar year for the price of gold itself, and that has rubbed off on a lot of the gold producers. I wonder if this story just sort of reminds us about country risk for anybody who's a big producer.
Yeah, 100%. And that's something that I really look at. For me, in my portfolio, I hold Agnico for that reason. They're local, they're domestic. Their mines are in Ontario and Quebec, and we don't expect to see similar situations we're seeing in other places. With some of the other smaller mining companies, it's geopolitical risk is really something that needs to be focused on. And if you're a retirement client, it's best to really have investments that really don't have that geopolitical risk.
And are you still bullish on the price of gold itself?
Yes, I am. It's really been driven by multiple factors. The number one factor is central banks, primarily China, are really buying a lot of gold right now. It's sort of the play with the geometric situation with so much happening around the world right now. And gold it's up to what, 3,400 an ounce right now, and it's for the junior miners and the miners altogether. Their all-in sustainable costs are about $1,200, so it's a reason to print money right now, and that's why we've seen such a good gold bounce over the past year here.
We also got some numbers from Franco-Nevada, which the market is reacting to as well. I don't believe that is a stock that you've held in portfolios, but what's your view on what's happening with that business? Their business model obviously different than, let's say, a Barrick.
Yeah, that's true. They're into the royalty and the streaming business, where Barrick is a miner. They go out, develop, they explore, and they develop the mine. So there's a little bit less risk with Franco-Nevada because of that, but you don't get as much upside. And I think in the market right now with the price of gold where it's at, I think there's a lot of upside. That's why I like where the miners are at. I think the miners are catching up to the price of gold. So I'm still quite bullish on a lot of the miners.
So it's been a big year, obviously, for the materials sector, as you alluded to in Canada. Technology's had a big year as well. And we were referencing that the market is responding positively to the latest numbers from Constellation software. What's been your observation on how Canadians are observing tech stocks that are listed on the TSX, like a Constellation?
Yeah, that's a good point. We're really seeing it, the golden child right now this year at Celestica, and Constellation is up today, which is great, but it really hasn't performed as well. They're a different type of business model. They're into the vertical markets software, where they're out buying niche software products, and they've been doing this for years and years and years. The issue with it is that they're taking their free cash flow and buying more businesses. And so their revenue is up 15%, but their organic revenue is up only 5%. So without out there buying new businesses with their free cash flow, they're not compounding their cash flow. So I think that there could be some benefits if they would perhaps increase their dividend and focus more on just growing their organic business.
Okay, Mike. Steve, thanks very much. Steve Rowles joining us, Senior Portfolio Manager at TriVest Wealth Counsel, Wellington-Altus